Hi everyone, this is Sanjeev. Today I've got a very special guest who is very well known and respectable person here in Australia in the property world. He's also a residential property writer over 35 years, a researcher, mentor to many businesses and successful individuals. He's also quite often seen or in the media, but most often in the other side of the news, where he's sharing the positivity about the property world, uh, with proper data and insights. So yeah, I think he has built his own massive property portfolio over the time, and today I have the privilege to interview him to share his own property journey, so we all can learn, take some learning along with us, and implement in our own property journey. So let me welcome Terry.
Thank you, Sanjeev. It's always a pleasure to be talking to you, and particularly to be talking about my favourite topic, which is the housing market across Australia.
Yeah. So yeah, I know. I mean, so you talk about the definitely generally people ask you in other interviews about the hotspots and the research and what's going in the property market. So of course I will touch, but today the whole thing is to get into, like, how, where did you all started, where this all started for you, how did you get into this property world? So bit of a background and yeah, your own journey.
Yeah, it started with my original career was as a journalist working for newspapers, firstly in New Zealand, and then I came to Australia in the late 1970s, and I was working at the Courier Mail newspaper in Brisbane, and one day the editor called me in and said he had decided to appoint me editor of the property section of that newspaper. And I was surprised because I didn't feel I knew very much about real estate at that time. But having been appointed to that position, I decided to make it my business to become as informed as I could be. And I did that job for the next 4 or 5 years. And over that time, I think I became much better informed about real estate generally. Then I went to the Australian Financial Review as a property specialist journalist. And at that time, I was receiving a number of offers from people in the industry to come and do work for them as a consultant because what I was doing as a journalist was I was doing a lot of my own research and turning that into news articles and features, and that's something that nobody else was doing at the time. And so I was getting a lot of offers from the real estate industry to come and do work for them, to write reports for them. And I couldn't do that while as a journalist because there was a conflict of interest. So I decided to stop being a newspaper journalist and start being a consultant to the property industry. And so I was originally just a freelance consultant working in the offices of major property firms. And then I started about 2006, I started the hotspotting.com.au website. I was writing freelance for the Australian newspaper, for Money magazine, and I did a series of features on what were the characteristics of the areas that outperformed on capital growth. I did a series of articles for Money magazine, trying to highlight the characteristics that the locations that outperformed had. And while I was researching and writing those features, it occurred to me that maybe there was a business opportunity in that a lot of people wanted to know about the areas that were going to do better in terms of capital growth and what the characteristics were of those areas. So I started hotspotting.com.au as a website-based business selling reports in 2006. And I'm still doing that. It's grown, particularly in the last few years. We've got better and stronger. And despite the difficult markets that we're currently in, it's still as strong as ever. We're still getting good demand from people for our products. So it's still continues to go well.
I think definitely people are always looking for the right information, the right data. So now tell me, it's interesting because you started back in early 20s. So I'm like curious because the technology might be different, because right now we have so many things, right? You can now buy data, do this, you use hotspotting report. For you guys in the background that time, what was available? Like you said, you're doing your own research, and that's why you're different than the other journalists in back in the industry. So what kind of tools was available that time?
Well, there really weren't any tools. But I'm talking about the 1980s and into the 90s. There was no core logic. There was no domain. Those sorts of online entities didn't exist, and that there was no packaged data about prices and vacancy rates. Um, so that was why I did my own research, trying to pull together whatever information there was from the real estate institutes, for example, and from government departments about prices in particular and rents, and try and make some sense of them. So it was really the beginnings of something that has now obviously become common. And right now we've probably got too much information available to people. We've got the opposite problem. We've got information overload, and we've got conflicting information, and we've got really bad analysis of information in mainstream media. So we have the opposite problem. But back then there really were no tools that identified which areas were growing the most and what median prices were in certain areas. None of that existed.
Must be very interesting. I mean, that time I'm sure people will be more relying on the media, and that's where media can play a big good or bad role depending on what information is out there, right? But on the other side, right now you have too much information, so it's like finding where the right information is. So okay.
Yeah, it's really hard for people to know what to believe at the moment. For example, in the last few weeks, we've had a number of entities publish their figures on what they say happened to prices in the month of October. We've got CoreLogic and PropTrack and SQM Research and others, and they don't agree. CoreLogic says prices fell everywhere, but PropTrack says a number of our major cities prices actually rose in October, and SQM Research would tend to agree with PropTrack. So it becomes very confusing for consumers. Are prices falling? Are they rising? These reputable, supposedly credible organisations don't agree on that. So what chance has the average consumer got?
No, I agree. I mean, it's yeah, it's just so confusing, and that's what it leads to, like fear, doubt, and people are not able to take any action even though they want to do it. I mean, now of course you're expert, so but how did like you get into the property journey? What kicked you to like invest in property, and how has been the journey so far? And yeah, a process, what's happening in your mindset, process or philosophy around all the investing for yourself?
Well, I first decided to buy my first home. It was the early 1980s because I'd been renting. I was in the Brisbane Metro. I was actually out at Ipswich, which these days is a market that a lot of people are interested in because it's a growth market, affordability, etc. But I was renting, and I was finding myself constantly having to move for various reasons. There was even occasions when I got evicted by the landlord because he thought I was doing the wrong thing, and I got tired of being shunted around by landlords, so I decided I needed to buy my first home. And so I bought a home out in a suburb of Bundamba in Ipswich in the early 80s. And it cost $25,000. And a couple of years later, I sold that at a profit and moved closer into where I wanted to be because I was working at the Courier Mail in one of the inner city suburbs of Brisbane. I wanted to be closer to where I was working. So I bought in inner city suburb of Balmoral a house on a hill with views of the Brisbane River. Cost $50,000. So I started the journey of upgrading to heading towards the eventual, achievement of what might be described as the dream home. What I know now and wish I knew then was, my philosophy now that I try to preach to people is that you achieve wealth in real estate by acquiring good assets and keeping them. You don't buy and sell. You buy good assets and then you add and you build a portfolio. That property I bought for $25,000 would now be worth over $500,000. The one that I bought in Brisbane for the first time for $50,000, the land alone would be worth over $1 million. And I very much wish I still own those properties. So what I've learned along the way is that you shouldn't buy and sell to advance. your wealth, you should buy good assets and keep them. And I eventually learnt that at some point of my journey and started accumulating a portfolio rather than buying and selling and upgrading.
Yeah, I mean that's interesting because a lot of people ask, that, hey, Sanjeev, when should I sell this property? Of course, let's buy, but then at what point you sell it? So, so I think what you're saying is like, if just keep it them, right?
Yeah. Well, just earlier today, I did a strategy session with a couple based in Sydney, and their mentality was they owned their home plus 5 or 6 investment properties, and they were asking questions about which one should we sell, that one, and buy something over there, and the whole mentality was buying something and selling something and buying something better. And my suggestion was, keep. You've got good properties, keep them. Just add to your portfolio. You would only, I think, really seriously consider selling a property if it was underperforming in your portfolio and holding you back. Because sometimes property investors get to the point where they have 6 or 7 properties and they have a certain amount of debt and they can't get a loan anymore because the banks look at the amount of debt that they have and decide that they're too big a risk to lend to. And those circumstances, it might be a good idea to sell a property in your portfolio that's not performing very well and free up some borrowing capacity and maybe some equity so you can do more things. But generally, I think it's a mistake that people make, because when you sell a property and buy another property, that exercise can maybe cost $100,000. In selling cost and buying cost, stamp duty, capital gains tax, perhaps, legal fees. It can be a very expensive exercise, but you don't need to sell a property to be able to use the equity that you have in a property to buy another property. So I think it makes sense to keep good real estate assets and just add to them.
So now, Terry, like, what do you classify as a good asset class? Which you just keep and keep adding, like from your perspective.
Well, I think the secret is to understand something about what drives locations to show better growth than other places, and select property in those locations. I've always been a believer in buying perhaps towards the lower end of the market in small chunks. If I had $1 million available today, I wouldn't buy $1 million property. I would buy 2 or 3 properties, because I think that makes a lot more sense. I like property that pays for itself. In other words, is positive cash flow, or at least cash flow neutral. I don't believe in negative gearing. So you're more likely to achieve that with the lower priced properties, and that's important right now as interest rates rise. But also, many of the cheaper areas show equivalent growth to the more expensive, and percentage terms. It's a fallacy that some people believe, the myth that expensive property shows better growth, and I don't think that's true at all. I think if you look at the research numbers, for example, I was again referring to that Sydney couple I was speaking to in a strategy session earlier today. They were in a quite an expensive area of Sydney where the capital growth rate was inferior to an area like Blacktown in Western Sydney, where it's considered a more down market area. And most of those suburbs have long-term growth rates of 9 or 10% per year over the last decade. And that's superior to some of the more expensive areas of Sydney. So I think it makes a lot of sense for people to buy in manageable sizes, bite-sized chunks, as I like to call it, and superior rental yields, good credentials for growth, and just add to it and build up a portfolio over time of maybe half a dozen properties, and then 10 years later you might have 10 or 12 properties, and that starts to become something that you can consider retiring on.
Yeah, no, I agree. I mean, at the same time, Terry, I mean, so I follow you, and I think just same recipe what you just mentioned. By neutral positive cash flow in the lower market. If I have $1 million, I'll prefer 2 to 3 properties. So yeah, no, I think that's what has helped me, achieve what I have achieved in last 10 years. So now I totally agree with you, and I think it just reconfirms, no, listening from someone like yourself, um, that that is a good strategy to go with. I know it's a stress free, and opportunity do exist, and it is a ripple effect also. Like, I bought properties, in regional towns, and this year itself, I know I'm in a position where I'm able to take out more than 500,000 equity from 3 properties. So think about just a smaller chunk while they're positive cash flow, 500,000, right? It's a decent money, I would say, and last 3 4 years, 5 years. So um, okay. So now, Terry, like, on the way, I see all the investor faces challenges in terms of, because once we get into that, no, the fear is all gone. We don't look at the rate of interest. We don't. I mean, we of course do the number and maths, but we don't look at, we focus on buying, right? But then the borrowing kicks in, the like serviceability and all those things. So what are some of the things you have done in your own property portfolio which has helped you to keep buying? I know this year also you have bought a couple of properties, and now you always looking for ways to buy. So do you want to add on that, Terry?
As I said earlier, my philosophy these days is never ever sell. But of course, that's a nice philosophy to have. But there are exceptions, and sometimes you do need to sell something to open up new opportunities. There was a point a few years ago where serviceability became a problem, and I did have one property in my portfolio which had underperformed for various reasons. So I actually got rid of that, and it freed up some equity, but also, more importantly, it freed up borrowing capacity. So I'd reduced the amount of debt I had and got me below the threshold that lenders were comfortable with, so I could now embark on a further journey. And what I'd probably say to people is, the way to achieve, I think, the sort of wealth goals that a lot of people would have is to buy good assets, keep them, accumulate, and create a portfolio. And at some point in your life, you might end up with, you might have 10 or 12 properties. And the idea then would be maybe to sell some and reduce the debt in others so that you achieve the level of cash flow from the remaining properties that you need to live off without having to work for a living. So that, there will come a point, when people reach an age or stage in life where they're considering retirement or early retirement, that they can sell some properties and adjust the debt levels down to achieve the level of net cash flow that they need to live comfortably.
So, okay, of course. I think, yeah, if you see in the properties, that means get your property portfolio reviewed regularly, so that now if you see any opportunities, then no, maybe drop off, I mean, sell those assets, and then move on. Um, I know. I mean, do you buy properties under different structures and all, which helps you, those kind of like self-managed fund and those kind of structures, as a sophisticated investor, Terry?
Yeah, and the kind of work that I've been doing for a long time as like someone who writes in media and comments in media, and I'm usually quite outspoken, express strong views. For me, asset protection has always been important. I've bought property and structures like trusts that achieve, better protection of assets. It's also, I think, important to have different entities for various reasons. If you owned a lot of properties in one state and one entity, you'd be paying a lot of land tax, for example. So there's all sorts of reasons to have different entities, and wouldn't consider myself an expert on that. And it's something that people should get advice from an accountant or a specialist property lawyer on. It's really important to take that time and spend that money to get that advice before you buy something. Quite often I hear anecdotes of people who've got the trouble through buying in the wrong entity. They didn't seek advice from a property lawyer, for example, before buying a property, and found out too late that they had the wrong structure, whether it's in their name, their wife's name, or in some trust structure. And then, of course, there's the issue of self-managed super funds, which is another avenue available to people. I've got my own self-managed super fund because I thought the performance of the big super funds was pretty poor, and they charge big fees even in the years when the size of the value of the assets reduces in a bad year. They still charge the same big fee. So I took my money out and created my own self-managed super fund and bought real estate with it. Um, and in that case, it was important to have sort of high yielding property, which involved buying in some regional areas with really good rental yields, but still credentials for growth.
No, I agree. I mean, yeah, I mean, see, if you buy properties under your name, under your family structure, then why not under self-managed fund if you're an investor? So, and of course, if you want to diversify, invest in shares or few things, then yeah, definitely that avenue is there. So, what sort of areas, or when you're looking for yourself, like or the factors in the you look in a specific area, or the state before you buy your own property?
There's sort of factors that I look for in choosing a location.
Yeah,
Yeah,
yeah.
like I believe that real estate markets are local affairs. The media always talks about the Australian property market. Australian house prices are going to fall 5%. And I don't think there's any such thing as the Australian property market. I think there's thousands of markets in this country, and they're all local, essentially. And so I'm very interested in local economies because I think growth or otherwise in real estate arises out of the local economy. So I'm interested in, apart from, I've got sort of price range I like to buy in, so that helps to dictate where I'll buy. In the price range, I'm interested in buying in areas with low vacancy rates, therefore strong rentals, therefore strong rental yields. But I'm interested in the local economy. Is it a growth economy? Is it diverse? It's very important to have diversity in the economy. I don't want to buy in an area where the local economy is totally dependent on the agricultural sector, for example, because it's vulnerable to, say, drought or bushfire or those kind of factors can affect local property values. I don't want to buy in a mining town because it's just one very volatile industry there. I want to buy in a location that's got 5 or 6 or 7 strong economic sectors, an economy that's creating jobs where the population is growing. And in particular, I look for areas where there's a big infrastructure spend because that generates so much. It generates local business, it generates jobs, and out of that comes demand for real estate. But it also creates new infrastructure that improves the appeal of an area, like it might be a new hospital, a university, better transport links, a new rail link. All those things have a big impact on real estate. So I'm looking for all those factors. But it all comes down to, in simple terms, what's happening in the local economy. Is it likely to generate jobs and business and therefore demand for real estate?
I think that's why we follow you, right? And it's yeah, it's the right fundamentals, the biggest spend, the local economy, and of course, not only look at the shiny thing, but look how to mitigate the risk, which, as you said, right, diversified economy. So um, now, Terry, like, how do you, like? I know you have got all the information yourself in your hands and everything now. When you're buying a property, like, are you buying yourself, or you use any professional services for your own properties, or what has been the process on that front?
Yeah. Look, I always use a buyer's agent, somebody not unlike yourself, Sanjeev, because, as you point out, I've been doing what I do for a long time. I've got a lot of knowledge and experience, but I'm time poor, and I just don't have the time to do it well because, as you know, as a buyer's agent, there's a lot of work in finding the right property for your client. There's a lot of research. There's a lot of legwork. You quite often examine a property and find it's not, for some reason, it's not suitable. Then you're going to have to look for another one and another one. And eventually, it might take weeks or months to find the right property. And I don't have that spare time. So I'd much rather pay a fee to a trusted buyer's agent to do all that work for me. Give them very clear criteria, tell them exactly what I'm looking for. This is my price range. This is the type of property I want. I'm not looking for something that needs work done to it. For example, I want something that's low maintenance, or it might be I want a property that's on a a larger block that maybe can be subdivided in the future. Give very clear criteria and let them go and do their job, and be happy to pay the fee, because if you buy in the right areas, and I always try to buy in good areas, in less than 1 year of capital growth, you've paid for the buyer's agent's fee and the stamp duty and all of that, and you're in the black in terms of equity. So I think it's worth. Um, I always say to people, before you build your portfolio, you need to build your team. I think that's really important. And I think a lot of investors don't do that. They're not willing to spend money on advice or research. And I think it's a mistake. I think it's false economy. People should gather around themselves a team of trusted advisors, a good accountant who understands real estate, a good property lawyer, a good buyer's agent, a good mortgage broker, and build a team. And then, having built that team, you can then start to think about building a property portfolio based on good advice, to increase your chances of buying the right property at the right price in the right area. Because far too many people just buy badly, and it really slows down your wealth creation process if you buy properties in the wrong places.
Yeah, no, actually, because I quite often talk to you, and when you said like on the chat that you use Virgin, I was like personally surprised. And hey, come on, there you have all the connection, the real estate agents, you have the information, everything. You have all the right education. So why are you using? Of course, I mean, of course, your time for you want to leverage, and but yeah, that's our thought. Okay, because a lot of people think, hey, I can do myself and do this. I mean, yeah, of course you can do it, but I think there's more to it. So, yeah.
I mean, a good buyer's agent will be active in it. I know, for example, that you've been buying a lot in Perth, and that you've built up a lot of knowledge and contacts in Perth. So, on behalf of your clients, you can recommend perhaps a property manager. When they've bought a property, you can organise building and pest inspections and all of those things using your local contacts that you've built up in that area. Just saves me, the investor, so much time, and that's really valuable to me, because I'd rather put my time into developing my business. And I think the other thing is, it's important for investors to realise that property investment is a business in itself, and they should treat it as a business. And a good business, you spend money to make money. And I think one of the best, I quite often still write for Money magazine, and sometimes they have a cover feature, and they ask a range of people to say, how would you invest $10,000 right now? I think it's a rather strange sum of money. And a lot of them say, I'd buy BHP shares or whatever. But my answer always is, I'd spend my $10,000 on a buyer's agent to find me the next property, because I think that's the best investment that I can make. Invested in a good professional that I trust to go out and find me a great property, which 5 years from now would have made me maybe hundreds of thousands of dollars. Not a bad return on a $10,000 or $15,000 investment in a buyer's agent.
Yeah, no, I think a good consultant, your professional, pay for themselves, right? Like, I pay much more. Actually, should pay maybe more, 10 times the investment, I believe. So
Yeah,
now,
absolutely.
Terry, a lot of people reach out to me and say, hey, I'm in my early 50s, and is I'm too late, or should I start investing? And of course, all those range of people, right? Now, you're in your 60s, and you're every day looking for properties, I know. so what do you have to say for to people, who think I'm too late to the party of this property investing? Of course, who want to do it. I mean, so don't want to do it. No, nobody can help them. But people who are looking, what do you have to say to them?
Yeah. We might say somebody who's 60 years old and think, it's too late for me to start. It's not. I imagine a person who's 60 years old would still like to think that they're still going to be around on planet Earth for another 20 or 30 years. So imagine if you buy something, you're 60 years old, you buy a property today, what will it be worth when you're 70 years old? And what will it be worth when you're 75 years old? There's still plenty of time for an asset that you buy today to be worth, considerably more in your lifetime. and to fund your retirement. And um, to when I'm that age, I hope that I'm travelling a lot. That if I have health problems, that I can afford good care, and all of that is a good reason to have a property portfolio. And I would also say that along the way, and I bought my first property when I was in my 20s, but there've been hiccups along the way. Everybody in their life has reversals, problems, maybe divorce, and relationship breakup means that assets are divided between the two parties, and you kind of got to start again to a certain degree and rebuild your portfolio. So I've had all those sorts of things happen throughout my life. So it hasn't been sort of plain sailing from a young age, but you just keep doing it. Trust in your process, have a strategy, um, and just keep applying it. Sort of like Warren Buffett, one of the richest men in the world. He's in his 90s. He still goes to work every day. He's still working, still doing what he does because he loves doing it. So I don't think you necessarily stop because you get to a certain age.
I agree. I mean, yeah, we all have to look forward to the life, right? And every day brings new opportunities. I feel like people, sometimes they give up too early, and that's where, yeah. But I think, and that's where, I know we have people like yourself, so we can all can look as an inspiration and say, hey, come on. Or Warren Buffett, you said 90 years and he still goes to office. I mean, see, he don't have to, right? So now, Terry, I know you have a big property portfolio, and also what's the plan? Like, any time you're looking to consolidate, increase the cash flow, or like, what's your plan for these properties?
Look, as I alluded to earlier, I think at some point I will sell probably some and just adjust the debt so the cash flow is stronger on the ones that remain. I think it's important to probably to have a concept of when is enough enough. It's how many properties do you need to be comfortable? And I think some people just keep buying and accumulating because I don't know. I'm not quite sure what the philosophy is, but I believe that having a concept of what's enough for you yourself, um, and and keep revising. What's the cash flow position? How much do I need to maintain the lifestyle that I want to maintain? For me, the biggest expense that I'm ever going to have is travel because that's what I love to do. I just want to, as long as I'm physically able, I want to be traveling the world and seeing places I haven't seen before. That's a certain expense, so I need to factor that into my calculations of how much I need to earn off my property portfolio when I stop working. If I stop working, because the question is, do I want to retire? When I love what I do, am I going to retire? I love to write. I'd like to write more books, for example, so I'll probably never stop doing that. And so there will always be income coming in some form. So, but yeah, at some point I'll probably sell down some of the portfolio just to reduce the debt and make the cash flow more.
That's good. I think I agree with you. I mean, it's finding that where's the fine line, where once you have reached to that position, that what is enough, and and then I think it's still I'm working out on my end goals, and things changes, but yeah, it's like getting deep dive inside, asking yourself, otherwise you always keep chasing, right?
Yeah, yeah. I think the enough is an important word to keep in mind. Not to be to just accumulate assets just for the sake of it, and looking at your spreadsheet and look how much money I'm worth. It's a bit of an ego trip for some people. Whereas I think it's because there's always risk involved when you buy real estate. Even when you buy in good places, there's an element of risk, and at some point, you want to de-risk and just sort of enjoy the fruits of all the hard work you've done. in your life so far.
Yeah, I mean, yeah, eventually it's all, to enjoy the fruits of it. So I think, yeah, it's just okay. Now, Terry, right now in the market, a lot of negativity, rate of interest going up, and people think rate of interest going means, property prices coming down and all. Should I buy in this current market and all? What do you have to say to those people?
Look, I think people will need to tune out all that media white noise and just get on with business. It's not as bad as media would like us to believe. They do love negative sensation. And as I pointed out earlier, the situation with prices depends on whose figures you believe. It's certainly not the case that prices are falling everywhere, and it's certainly not the case that prices are falling a lot. I think it's when you sort of dissect markets and analyse things, there are very few locations that have had substantial decline in values. I think it's quite moderate. Um, and I expect 2023 to be a growth year in real estate. We've got a serious shortage of properties in this country. We're not building enough because there are problems in the building industry. We've got a shortage of rental properties, definitely. We've got our international borders open again and migrants coming back in and international students, and the federal government planning to lift the migrant intake because our businesses are having trouble filling their job vacancies. So I think the shortage is going to get more severe, and that's going to put impetus in property values next year. There's a lot of positive things happening. I also think that by the time we get into 2023, most of the interest rate rises will be done and people will have adjusted. And the reality is that wherever interest rates end up, they're still going to be low by historic standards. I remember the 1980s when I owned real estate and interest rates were above 10% and they went up to 17%. Property prices still rose through that period. In the early part of this century, there was a prolonged period of where interest rates rose, and they're much higher than they are now. People were typically paying 7, 8, 9% on their mortgages, but property values were rising through that period. So I think once everyone adjusts to this period of interest rate rises and realises that actually interest rates are still quite low, and just get on with business, and just trust in bricks and mortar, which performs very well for Australians, has done over the years, and I think will continue to do so. And we'll see plenty of growth in 2023.
So did you say in the 90s, rate of interest was at one point in time 17%, and still the
Yeah,
property prices are
well,
going up?
prices stopped rising by the time they got to 17%. But I mean, throughout
Okay,
a couple of years, interest
17.
rates were above 10%, and they kept on rising, and prices kept rising. In 2001, 2, 3, we had a property boom in Australian interest rates. Mortgage rates were 7%, 7.5%, and they rose to 8% and to 9%, and we still have prices rising. That needs to be remembered. And the other thing for investors right now is certainly interest rates are higher, but so are rentals. Yields are rising, and you've got quite a favourable equation. In many parts of Australia right now, markets aren't as strong as they were. They're not as competitive as before. So you can buy perhaps better at a time when rents are rising and yields are rising. So, you might buy a property now in a location with a rental yield is 5.5%, but in a couple of years' time, it could be 7 or 7.5% because rents are rising so strongly. And there's no end in sight to that shortage. There's no government policy that's going to fix the rental shortage in the short term. So higher yields is compensating for higher interest rates, and it's a real opportunity for investors, I think, right now. So people just need to think clearly. Okay, forget what the media's saying. Buy in good locations with growth credentials. Take a long-term view, as you always should, and keep in mind that low vacancies and rising rents is a big factor now. That's the thing to focus on.
No, that's really helpful, Terry. I'm sure, it will help a lot of the people listening today. And yeah, so I think I've taken a lot of your time today. Any final words for the investors?
Property investment is a business. Treat it as a business. Understand that you need to spend money, not just on the piece of real estate, but on good advice, good research. Be willing to do that up front to get a better result. Treat it as a business. Any business, you've got to spend money to make money. It's false economy not to do it, and too many people make that mistake. And just remember the philosophy of never ever sell. Acquire good assets, keep them, and accumulate a portfolio. And you don't need to be in a big hurry. You don't need to be frantic. You don't need to take big risks. If you buy one property every 2 years, for example, and if you're 30 years old and you start now and you buy a property every 2 years, in 20 years' time, you're going to have a portfolio of 10 properties. And the one you bought when you're 30, at the age of 50, will probably be worth 3 times as much. So it's, you don't have to take big risks and be in a huge hurry. Just get started, have a philosophy, have a strategy, invest in good advice, and you'll do well.
Thank you so much, Terry. I think now that was really helpful. I think even I got a lot of nuggets, and the philosophy of just reinforces those things, right? So thank you so much for your time today, and I think you have an awesome day. Thank you so much for tuning in today. Hope you enjoyed and learned something new from this episode. Please don't forget to review our podcast and tune in every Tuesday 8 a.m. Sydney time to listen to all our inspirational guests and learn from their property journey. In case you're looking for help with your property investment journey or building a property portfolio, please visit our website www.investorsdream.com.au to learn more about us and our services. And feel free to book a call from our website for a friendly chat. Have an awesome life and happy property investing.